Well, I'd like to thank everybody to this week's town hall. Myself and Mel will be doing the presentations today. It's that first day in February already. And it's like, wow. I remember when it seemed like summer took a long time as a child, and now the months just kind of fly by. So I'm going to go ahead and start it today. And Mel, you do have the availability. I have, if you want to share a screen, we're going to go ahead and let Mel kick off. Deanna is not going to be joining us today. And then I'll follow up at the end with a few comments. So Mel, you want to go ahead and take over?
Happy to. All right. So I've got an interesting subject to talk about today. It's something that we've been doing for a while for clients, but we have a new take on it. And when it comes to financial planning, we talk about it all the time as a holistic approach. It's about more than rate of return. One of the things that we've been talking to a lot of people about for quite some time is tax efficient income planning, our tax efficiency in our retirement planning. There's just a couple of thoughts of thinking about things a little differently. So I want you to think about qualified money, IRAs, 401ks, 403bs, tax deferred money. We got a tax deduction or a deferment of the taxes when we put the money into those plans. So that money we still owe taxes on, plus everything it has ever earned. And when we look at IRAs, there's a couple of conflicts. There's actually three major conflicts with an IRA. One, growth versus protection. Once we no longer have that paycheck, we have our Social Security, maybe a pension, and then we depend on our assets to produce additional income for our retirement. And it becomes a conflict of, if I go for growth, I have to give up safety. If I go for safety, I have to give up growth. I'm not going to spend a lot of time going through the different aspects of that, but when we look at CD rates, money market rates, falling bond rate values these days, where do you find safety with upside potential and still get growth? That becomes a real conflicting approach to where do you put your money in an IRA account. The second big conflict is income versus legacy. It's a zero-sum game. For every dollar that I spend out of an IRA, that's one less dollar that will happen for legacy. The other side of the coin is every dollar I don't spend and leave for legacy is a dollar I don't get to spend. So for people who are interested in leaving a legacy payment to children or charities or things of that nature, that's another conflict. So how would I go about getting both of those? I want to spend the maximum income for myself and I want the legacy, or some combination of the two. Where in the world would you find something like that? It's an interesting choice in looking at different investment portfolios or different aspects of investing. The third big conflict is you versus the IRS. The more money you want for yourself, every time you take a dollar, the IRS is a partner. They get a share. The biggest difference is, and I want you to think about the IRS as being a partner in your assets. We talk to people all the time, say, well, I have $700,000 in my IRA. Do you? Really? How much of it can you spend? Let's say that you're in an effective tax bracket of 25%. If you take federal and state and put it all together, you don't really own all $700,000 of that. About 160, 170,000 of it belongs to the IRS. Here's the difference. You can determine up to a point how much you take out of your IRA or 401ks. And I say up to a point because once you hit age 72 now, the IRS will tell you you must take at least this much because they want their cut. They want their share of what you put away and everything it has earned throughout your working life. The other aspect to that is you don't get to choose how much tax you pay. At that point, the IRS is deciding how much tax you pay, and the government has the right and the privilege of changing how much they're allowed to take. Now, we currently are in the lowest tax bracket structure we've had ever due to the tax changes in 2017. If I could poll all of you right now, I seriously doubt that I would get a lot of you to agree that taxes are going to be lower in the next 5 years or 10 years or 15 or 20 years. I think the majority of us would agree that taxes are likely to be higher in the future, even than they are now. So if I'm choosing between how much money I get and how much the IRS gets, and I am fairly certain with the assumption that the IRS is going to take more in the future, when would be the best time to do something about that? Right now, most likely, because we would pay the least amount of tax to make any changes we want. So here's the dilemma. It's called a saver's dilemma. If I want growth, I take risk. And if I want safety, I don't have the growth. How do I get both? If I want income for me and legacy for my family, how do I get both? If I'm doing me against the IRS, how do I pay the absolute least amount of taxes possibly over my lifetime? We spend all of our time looking at deferring taxes because I don't want to pay the taxes today. That's called micromanaging. I'm looking at this year and this year only. If you look at macro, well, how much is the total tax going to be during my retirement? If I've got a life expectancy of between 85 and 90 years old and I'm 60, I'm talking about 25 to 30 years. How much tax am I going to pay over that time period? How much fee am I going to pay over the time for managed assets? How do I limit the fees, maximize the income, maximize the legacy, get the most growth, get the protection? That's a whole lot of ask to do with a financial plan. Well, fortunately, there is such an animal that exists out there today, and it's under this IRS code 7702. We know what 401k is. It's section 401 and paragraph K of the IRS code. We know what a 403b is. We know what IRAs are because there's codes in the IRS tax structure that tells us how they work and what the rules are. Well, there's also a tax plan structure called the 7702. And fortunately, it actually allows you to accomplish most of the things we've been talking about. It allows for a good potential growth while protecting the asset against market downturn. It allows for you to maximize income and minimize taxes while maintaining a legacy for your heirs and minimize what the IRS gets. It's not really new. It's been around just a little bit longer than the 401k rules have. And I'm talking in code here, guys, because what I just described is indexed universal life insurance. And the code of the IRS that controls those rules is 7702. Now, it's interesting that a little Christmas miracle happened in December of 2020. One of the things that makes Index Universal Life work is the ability to put money into it for a minimum amount of life insurance. Well, it's kind of been baked in for a long time that the rate of return internally to a life insurance policy, according to the IRS, was between 4 and 6%. It had to make in order to, and that controlled how much death benefits you could have for how much cash you could have in it. And one of the advantages that we get from an index universal is to have as much cash as we can stick into the pot as we can for the minimum amount of life insurance. Well, the thing that happened in December is that the IRS changed the rules, or the Congress changed the rules and said that starting in 2021, that they can build these policies based on a 2% growth rate to maintain the death benefit. What that means to the public is this. I used to be able to put in this much money for that much benefit. Now I'm going to be able to put in between 2/3 to 100% more money. I may be able to double how much money I'm stuffing into the policy for the same amount of death benefit. And the reason that's hugely important is that the expenses of this type of planning depends on how much life insurance. So if I can put more money in for less life insurance, essentially what happens is I have more tax deferred growth, which means more tax-free income in retirement. So kind of exciting. It's a whole new aspect. If we haven't talked to you about this already, I would suggest that we set up a time to go over this because it's a really cool way to look at minimizing taxes over your full retirement lifespan. And it's just a lot better even than it has ever been before. Unfortunately, we can't retrofit ones that already are in existence, but we can use the new rules for new programs. So if you'd like to have a discussion about the 7702 plan for your retirement and meeting all of these things, growth, West protection, income plus legacy, and more money for you and less for the IRS. We'd love to have that opportunity to sit down and explain how it works. So that's mine for tonight.
All righty. Thank you, Mel. Again, I'd like to just thank everybody for joining us. I'd like to thank all of our clients who have given us referrals over the last year, and those that are following or the first time on the town hall. I would just like to welcome you. It's the big weekend, the big game, is on Sunday. And a lot of people ask about our crystal ball. And one of those crystal balls is based on who wins the big game on Sunday. If the Tampa Bay Buccaneers win the NFC conference, there's a chance that the market will go up. And if the AFC wins, chances are the market will go down. The funny thing about when you look at silly little predictors like that, that's 75% accurate on what has happened in the years in which those things have happened. I'm not suggesting that you give me a call on Monday and we move every penny that you have due to that, but it's just one of those things that we start talking about when people start looking into the future on what could happen in the market. The only guarantee we're allowed to give is markets will go up, down, or stay the same. So it kind of covers all of those bases. One of the questions that I had been asked during the week, Steve, what's going on with this thing called Gamestop and Reddit? And what is a short squeeze? So I'm going to try to explain that here very quickly. A lot of people think this is David versus Goliath. The big companies have shorted stocks, and the retail investors are out there pushing the stocks up in value, therefore knocking off the big funds. Not necessarily true. There are quite a few hedge funds that made a lot of money off of this GameStop trade because they owned shares in it prior to the run up in the stock price. And the idea of it is if you sell a stock short, you are actually selling stock you don't have. Therefore, you're going to have to buy it later. And if you sell it at $10 a share, the goal is to buy it back at $5. But with this run up in stocks, when it went to 50, 100, whatever it is, that means you have to buy it at that to cover your short sale. Therefore, there's an unlimited amount of risk that you have when you have to buy those shares because you've already sold them for $10 a share. The stock hit almost $400 a share. The problem with that, the institutions won't let you borrow that much money. So buyers had to start coming in to buy stocks to cover their positions, which caused them to continue to increase and go higher. And so it kind of percolated on itself. There's one gentleman, if you look at the Wall Street Journal on February the 4th, that says, and the title of it was, a day trader gambled, cashed out big. He made a $500 bet on an option, 40,000% return. And the statement that he made is he got out and took his profits, but he wished he never would have. I'm going to be willing to guess that he's going to be glad that he did because today the stock traded down almost 40% and it's back in that $50 range. It's down 84% this week. The problem when we get into using what I call more risky, more, they're like derivatives. People don't really understand them that much. Using more complicated investment options can be very difficult. The market's a zero-sum game. If somebody's going to make $100, somebody lost $100. If somebody makes $1 million, some other group lost $1 million. So that's when we start to look at this short squeeze. Does it always work? Not necessarily. They tried to do it. They tried to do it with silver this week, and it went up a little bit on that very first day, but because of the fact that there was not enough room, it came back down. So it's one of those tools that I believe they're going to regulate a lot more because of the manipulation of the market that went on with GameStop. Usually the person that ends up getting hurt is the little guy, not the big guy. So if you've got any more questions on that, please don't hesitate to give me a call and we can look at it. Selling stocks short, in my opinion, is very risky. You need to know what you're doing when you do it. I'm not as big of an advocate on the no cost to trade. Buying options that people might not really understand exactly how they do work is a good thing for investors in the market. A lot of this has been driven by people that did not experience the fall in 2000. Because I can remember that same mentality back in the late 90s, where you could almost open up the Wall Street Journal, throw a dart and hit a stock and buy it, and it was going to go up in value. And it became to the part that the market was not that difficult. Anybody can do this. Why isn't everybody making money? Which worked until the bubble burst at the end of 1999. And then from 2000 to 2002, the market was in a decline. A lot of people today that are new to the investment world have looked at it since 2009. We've had an upward trend in the market. So if you've only been invested for the last 5 to 10 years, you haven't experienced a 2000 or a 2008. And I think we have to be situated within our portfolios that no matter what happens in the market, that we're going to be okay. Because bears are part of a market cycle. We haven't seen a lot of them. We had a quick drop in February to March of last year, but we haven't had a sustained negative trend in the market for a while. The only thing that I will say is we're probably going to see one in the future, and I don't think I'm going too far out on a limb on that. So being prepared for whatever happens in the market is, I think, what retirement planning is about. If you have any questions about that or any of the things, Mel talked a lot about how the value of a life insurance contract has a lot of tax advantages in it if you know how to use it. The great thing about it, as I believe Mel does, I was grateful when he came into the firm to assist me with learning the true insights of and outs of life insurance versus I want to give you the biggest death benefit that I can possibly get for the least amount of money possible. That insurance contract can be used to your advantage to cover you for more than just one thing. Again, I'd like to say thank you all for being here. Those that have joined us live, for those that haven't, if we struck a question and you have one, please give us a call. If you know anybody that this might be advantageous to, please forward it to them. If you're a new person and you'd like to sit down and talk to us about these things and other things that we have that are available for you in financial planning that a lot of people don't talk about it, please don't hesitate to give us a call. We look forward to meeting with you. And again, with the pandemic still in there, we can meet by Zoom, conference call. We are taking appointments in the office and we'll be whatever your comfort level is in the office. If you prefer mask, we're okay with mask. We do have the partitions and everything set up in the conference rooms so that we do have social distancing, but we're here to keep you comfortable and assist in your retirement planning.